Hello, fellow investors, and welcome to another episode of Ritter On Real Estate. Got a little bit of a different show today. We're about 120 episodes in. We've had a great ride. We've been doing this for 2 years now. And as you guys know, I've talked about a lot on the show. Everything that we do, we're always seeking to improve. And so from that vein, we're going to switch things up a little bit this season. We're going to give you guys some new content, new formats, continue with fantastic guests. But we're going to start out here strong and flip the script. And I've got some great news to announce. We're going to start it by flipping the roles around a little bit. You know, one of the biggest things biggest pieces of feedback I've gotten is that in the show, I don't talk a ton about myself. And I constantly hear from people that they want to know more about my story. They want to know about more what's going on with Hudson Investing. What is Hudson Investing? What are we doing? So I thought that would be a great place to start and, put myself in the hot seat, get in front of the mic. And that also allows me to do something that I'm so excited to do, which is introduce you guys to the other guy that's on the line here, Curtis Edwards, who has joined Hudson Investing as our Vice President of Investor Relations. He's going to be running the mic today. And just like we do at the top of every show, let's start out first with Curtis. Introduce yourself a little bit. Tell folks about who you are and, why you're so passionate about multifamily investing.
For sure, Kent. Thanks for having me on. This is my debut on the Ritter On Real Estate podcast. So excited for this intro and many more sessions spitballing with you here as the year comes along. So yeah, my background, wow, what a wild 20 years. So I'll try to keep it concise here. But, I started out knowing that I love numbers and ended up going to Butler University here locally as a finance and accounting double major. I also, chose to play soccer at Butler for all 4 years. So balancing the social landscape, trying to keep the grades up and playing soccer was, probably the best lesson I got from college was juggling and multitasking and networking in those three big areas. So when I graduated Butler, I had an offer to go up and work for Merrill Lynch in their mergers and acquisitions department. And that just seemed like the right thing to do out of college. And after a year and a half, 2 years of, essentially ripping apart balance sheets and income statements and getting on the phone and starting to learn about these clients' needs from a lending perspective and who they were looking to acquire, I realized that I wasn't getting the essentially face-to-face interaction that I needed. So I left Merrill Lynch and got into the sales world with JP Morgan Chase, my first sales position. They didn't really teach that at college. And for me, it was the first job or second job I had, but it didn't feel like I was working. I was constantly on the move, out there meeting with clients, learning about their needs and how we could help them. And I just absolutely loved it. And what it did was it kind of kicked in that entrepreneurial spirit that I've had. Both my grandparents had their own businesses and were mentors of mine. And it kicked in quickly as I was out there interviewing and talking to all of these different businesses that needed help from JP Morgan. At that point, after about a year and a half in, I decided that I wanted to go start my own business. So why not, in the second largest pizza capital of the United States, open up a pizza shop in Chicago? Now, a lot of that was just being naive and being 26. And this was just before the great financial crisis. So that was my first capital raising, actually. I put half the money in myself and then raised the other half from family and friends and opened up a pizza shop, Pie Guys Pizzeria in Chicago, right around 2006. And it actually started out too easy. You know, we opened the doors, I had a line wrapped around the building, and everything was great for 6 or 7 months until the great financial crisis hit. And I remember putting my last bit of money in from the investors, really realizing, you know, we had to make this work. But, you know, over 50,000 people lost their jobs in downtown Chicago, and it dried up that lunch business during the day. And I had to pivot and do targeted marketing and really switch from a 70% dine-in to a 70% delivery business model to save this business. So that's what we did. We also pivoted and got our liquor license, and we were right there on the Chicago River. So we managed to survive the great financial crisis and thrive, actually. And anyways, sold that business. I had an interested buyer that came in and wanted to open up a pizza shop, which her family had back in the day, and sold that pizza business and decided to take that money and roll that in, you know, to a speakeasy, all beer focused concept in Columbus, Ohio. Me and my best friend had realized that, you know, everybody wasn't drinking Bud Light and Miller Lite anymore. We saw this trend on the West Coast, and we decided to get into the Columbus, Ohio market where we're from. We were probably 2 or 3 years ahead of the curve there, which explains the first year and having to educate people on, you know, the lambics, the sours, the gozes, and all the different types of beer versus just your traditional Miller and Bud Light. But we had that business for a successful 7 years. And by the end of time, we had 4 or 5 competitors all around us in Columbus, Ohio. And it felt good to be on the leading front of that trend, you know, in the Midwest market. Even though we were just a small shop and we had a bunch of regulars, we really helped educate that market. So you'll see a common theme throughout this of networking, working with people, trying to stay one step ahead, and really, you know, how can you help or how can you educate, you know, whatever the base might be. So in between that, I didn't work full-time at the beer shop. We staffed that. I made a pivot from the finance world and had a great opportunity to get into what I thought at the time, this is like 2008, 2009, what I thought was the best cream of the crop type of sales job. And that was medical device. And once again, through networking and just through my friend base, was able to get connected in with Stryker Medical. And I won't go through the whole story there, but went on a 11-year journey where I started out in sales in Chicago, where you're in the operating room, and then pivoted into the marketing department and launching brands. Then the R&D department, where I worked with surgeons and engineers to develop these products that were going in as implants during surgery. Then I came and worked in the education department, and how do we educate our reps better who are coming from all different backgrounds? And that took me all over the world. I started in Chicago, moved to Denver, Colorado, then to San Francisco, then over to London, where that was my base, to cover all of the European market, and then down to Stryker Australia. And that was the whole Asia Pacific market. So those 11 years at Stryker were amazing. You know, everything from sales to R&D to marketing to business development to education. And at the end of the day, it didn't really matter what role I had within Stryker. Once again, you were taking complex procedures or engineering documents or topics, and you had to simplify them so that the sales reps could communicate more efficiently in the operating room to the nurses or the surgeons, or you had to work with the surgeons and the engineers as the middleman to try to make that process of development more efficient. So that was a wild 11-year ride. And all along that, I realized that, you know, from my finance background, that, yeah, listen, I started and had all of my retirement money in equities. And I realized that I needed to be more diverse, especially into real estate. I have a family background in real estate. One of my first jobs was helping my dad flip homes in Columbus, Ohio. And my dad and my brother have been in the real estate space residentially, for over 30, 40 years. So it's always been in the background. And I've seen different ways that you can make money in real estate. And then when I look at how the wealthiest people in the world diversify their money, and especially as I've lived all over the world, you start to see that it leans more towards a big chunk into real estate, right? And there's many forms of that. But just the macro concept there was that wanting to be in real estate, not all equities, take advantage of that depreciation piece as well. So I started switching out of equities in the background, and I started my own single family rental portfolio in Columbus, Ohio, where I had inside information from my dad, deals off market, deals that had great floor plans, deals that allowed you to add another bedroom through an egress window and increase the rents, not knowing what was going to happen 10, 11 years down the road and where I was going to find my true passion and how I could maximize my skill set. But as I built this, single family portfolio, then I started getting into rental arbitrage in Nashville and Austin, in these markets where you could see these millennials wanting to move around. And you didn't want to essentially live in the condo that you rented. When you traveled, you wanted to be able to rent that out, and started looking at rental arbitrage and that yield perspective. And then also the Airbnb market in vacation areas, like Telluride, Colorado, or once again, Austin, Texas. So as I started looking at all of these different ways that you can make real estate, the goal really was to find the most efficient yield, right? The highest risk-adjusted return out there. And that's really what that taught me. What it also taught me is I wasn't a passive investor. I was active. I was dealing with tenants and toilets every day. Even though I had management companies in place, I still had to make critical decisions. And this was all happening while I was, advancing my career at Stryker Medical. So it was just a lot on my plate. And, after my 11 years at Stryker, I realized, I wanted to get out of the medical world and really back in to what my passion was, which is finance, which is numbers, which is relationships, and actually at the base is real estate. And I started diving down the rabbit hole of multifamily and was looking to start my own multifamily syndicate on my own, using the capital from selling my single family portfolio. At that point, I came in contact with somebody through my network once again, and it was a regional firm here in Indianapolis. And that's where I got, my 2-year start, specifically in multifamily workforce housing, targeting on the Midwest markets. And what a phenomenal education that was. And they were going through tremendous growth at that time. I was a part of raising the capital. I was the vice president of investor relations. And over that 2-year period, we raised over $150 million, really 18, 19 months. And so going through that tremendous growth and raising capital taught me a lot. And once again, the stars aligning and just letting your network take center stage. Kent, that's where, you and I met randomly and really just had a passion, right? That's where I saw both of our passion for this space, but also looking at how everybody else in this industry was doing it and where were there some gaps in the market on how we can actually connect with the community, and how can we do things slightly differently. And really, it was the best, serendipitous meeting I've had in my career, and how you and I, our two stars collided. And the wildest thing is through our business coaches as well. And yeah, so that went on a little bit longer than expected, but you can obviously, see my passion in the space, and hopefully you can kind of see that common thread throughout, which is building communities, networking, developing strong relationships, and really just educating people on my journey, right? A lot of this has just been my journey and me investing, and then trying to bring people I know, friends, family, into the fold, and essentially, bring like-minded people together and invest together and make money together. It's a lot more fun that way.
Yeah, absolutely. And Curtis, I mean, that is an incredible journey. You've done a lot of different things, a lot of good perspectives, and absolutely, I agree with you that serendipitous meeting has been incredible and was a big pivot point for the direction I was going, and being able to just accelerate our growth with a great partnership. And so, tons of value there. And so, you guys got to know Curtis a little bit, understand his background. He's going to become a recurring theme on the show as we start to throw stuff back and forth and discuss ideas. And he's going to be able to add a ton of value on how to raise capital and how to do it the right way with integrity, by building trust. And so excited in the future episodes to unpack even more of that. Today, though, what we're going to do is, as I said before, we're going to flip the mic around and I'm going to sit in the hot seat and we're going to let Curtis interview me. And it'll be interesting to see how this goes. I think it's going to go great. But really the idea is just to give you guys insights more into the business, more into why we're doing what we're doing, and also help you really avoid some pitfalls. And talk about our lessons learned, what went well, what didn't go well over the past 6 months, and we've experienced some incredible growth. So with that, I'm going to flip it over to Curtis and let him take the mic and we'll go from here.
Sounds good, Kent. Obviously, you've been a one-man show, at the early part of your career here, but what's happened in these past 6 months has been incredible, right? You've seen some tremendous growth in these last 6 months. And let's take it back to the beginning and really let's tell the audience about why you started Hudson Investing.
Yeah, so just a quick intro to kind of frame things up, because I haven't really talked about that on this show. I've been on a lot of other podcasts. You guys may have heard my story there, but hear from my audience, just so you guys understand where I'm coming from. I started out, spent a career in management consulting, right? Started a business in management consulting, sold that business in 2015, and that really kicked off my real estate career. Similar to Curtis's story, figuring it out, flipping houses, building a duplex portfolio, doing a lot of different strategies, right? Until I found multifamily and I found multifamily syndications. And the impetus of founding Hudson Investing in 2019 was really that I was having incredible success in real estate. I was getting returns that I didn't know were possible out there, honestly, because I'd never experienced that before. I'd been 100% equities as well because it was all I knew. And I wanted to bring more people in, similar to Curtis's story, wanting to bring in friends, family, right? And really allow the community around me to thrive and do better. And I thought that with my business background, my competency, and the success I'd had so far, that I was confident that I could do that. And so that was really the impetus for founding Hudson Investing, was to bring everybody else along the ride with me. And it's been an incredible journey. It's been largely a one-man show, as you said. And as I've gone through different partnerships on different deals and various relationships, when you're getting started, you just do a lot of things to try to figure it out. What I realized was that to really be successful in this space, you've got to surround yourself with great people, but you've got to also build, I think, a team that has a standardized process, understands the best way of doing things, and is consistently implementing that approach over and over again. And when you're partnering with people here or there, you don't get that consistency. You don't get that consistent level of quality, the standardization. And that's so important when you're growing any business, but especially when you're growing a multifamily business, and you're buying properties in different locations all over the Midwest. It's that consistency, that standardized approach, and finding experts that are all really bought into the same mission so that your team is aligned and you're all going that same direction. And so that was really what took me from understanding the need for a one-man show and how much I could accomplish to what we could do together as a team, and in really building out Hudson Investing.
Ken, do you want to give the listeners a little info on what, the team looks like now? Obviously you've been a one-man show for a while, but you've had a bunch of strategic hires here. You want to comment on that?
Yeah, so part of the growth that occurred over the last 6 months, because it's really been a crazy journey. I mean, if you think about 6 months ago, it was really myself, and I had a host of contractors that were supporting me, and really one intern who was doing a lot of my underwriting, who I taught to just kind of basically put the numbers in the spreadsheet. From there now, we've added Curtis to the team, who's really taken over building our investor relationships. We've added a director of acquisitions, a guy named Steve Meeker, who has a similar excellent institutional pedigree, who's 100% focused on finding deals. We've added Taylor Cherry to the team, who's our manager of investor experience, who's really just there to make sure every investor has a white glove experience. Walk everybody through the process. It can be daunting, especially making your first real estate investment, just very unfamiliar. So having somebody there to hold your hand, walk you through the process is really just the kind of experience I want to create for investors. And we're also hiring, we're actually bringing in right now a leader for our asset management team. As we've grown the portfolio and scaled, we've developed a need to bring somebody in to just be accountable for the performance of that portfolio and be 100% focused on driving value for the properties and to our investors. And so, yeah, building out that team of just rock star people. I'm so humbled by honestly, the quality of the people that have kind of gotten on this crazy ride with me and have been bought into the mission. And it's more than I ever expected. And I just am 100% confident that this is the right team, to help us get to the finish line or win the Super Bowl or whatever analogy you want to put, right? This is the right team to win. And so I'm just so excited for the future right now.
Yeah, well, we'll keep the analogies going here. It sounds like, what you just described, when I hear that, sounds like you have the foundation set, right? So why decide to hit the pedal, right? Or let that rocket ship take off, right? Why now on that? Actually,
Yeah, I
sorry,
mean, it's a great question, right? So I think there's, if you think about some lessons I've learned, I mean, in multifamily, really there's safety and scale, right? It's difficult to be an operator that only has maybe one or even two, three properties, right? As you scale, there's incredible economies that you gain from that, whether it's cost savings, whether it's the ability to have, better, more efficient insurance. There's a lot of things that reduce risk as you scale in a firm, right? It's also the ability to hire individuals that frankly are better than I am at any one piece of this puzzle, right? And that's what we have on the team now. I think I've got a great vision, the ability to drive strategy, create high-level relationships. But when you get into the weeds of asset management, for example, while I think I'm good at it, I'm not great at it. And frankly, it's not my passion at the end of the day. So the ability to bring people in where their passion is aligned with their role, and they're experts in that space, and they come from, institutional level training, I think that just adds reduces a lot of risk in the portfolio, right? And in what we can do for our investors. And also as you scale, it's better technology. It's the ability to, just better service our customers, the ability to find better deals, right? Have access to data and information. I mean, we spend $50,000 a year at this point on data, be able to be in the right markets, have the right information, find the best deals, know when trends are coming, right? Those are things you can't just do as a one-man show. And so all of that coming together is why I think to be successful in this business, you really do have to scale. And when you're bringing in other people's money, I mean, the first lesson is, we don't want to lose money, right? It's that number one Warren Buffett lesson. Don't lose money. And all these things that we're doing are about really reducing the risk in the portfolio, expanding geographically, expanding into better assets, and with a stronger team, all those things. If you think about why now, I mean, yeah, it's kind of a funny question. I mean, a lot of people are pulling back in the market right now. We've seen that on both sides. We've seen sellers, we've seen buyers really drop out of the market. A lot of people are uncertain on what's going to happen, right? Interest rates have gone up like crazy. It's really thrown people for a loop. A lot of people who had too aggressive of assumptions over the past couple of years are really struggling within their portfolio and not focused on new acquisitions. So I think where we've got a leg up is in the ability to be nimble. We've got a strong portfolio in Midwestern markets who are seeing right now just kind of catching the rent growth wave. As we've seen Indianapolis hit the top of the rent growth on the rent growth chart, which kind of surprised everybody in December. A report came out with CoStar, Indy ahead of Miami. And so we've got a great foundation to build on. We've got a stable portfolio. And so I think we're better positioned there with the current portfolio, not putting out fires. I think also, you can't operate out of fear. And I think at the end of the day, if you get past all the noise and you look at a longer term horizon, we are in my opinion, the best asset class, the most stable, the best risk adjusted return. There's huge need for housing. That hasn't gone away. What's happened is more and more people are just being priced out of buying a home, which is forcing more people to rent longer. As inflation continues, that's not going to stop. And because housing is a big part of that inflation, interest rates are high. So people are getting hit on both sides. And we're just seeing that need for an affordable housing option, and we're not able to build into that to a level to provide the supply in the markets that we're in to meet that demand. And so if you look at the long-term fundamentals, interest rates are not going to stay high forever. They can't. If you look at the other macroeconomic things that it's producing and what's going on. So I look at this as a time where I think we can pick up some fantastic deals over the next 18 months. So I wanted to be positioned to get out there and take advantage of that opportunity. Because if you think about in an environment where we have distressed sellers, where we have folks who's, we're planning on refinancing maybe at a 4% interest rate, and that's just not going to happen, right? You think about there's buyers that are sitting on the sidelines just out of fear. And if you think about the future environment, and future value, if we can buy deals now as interest rates come down, cap rates continue their compression, I think there's going to be fantastic opportunities to create a ton of value in the 5-year, 6-year time horizon.
Yeah, well said. I love the point on the distressed sellers because I do feel like, that's a topic that me and Steve chat about all the time. How do we keep our eye on that, right? So I think that's a great point there. Do you have any other comments or thoughts on cap rates here, the expansion or the compression, around that topic?
So Curtis, great question on cap rates. I think there's a fundamental flawed assumption or understanding that cap rates move in lockstep with interest rates, or that interest rate increases drive cap rate increases. While there's a correlation there's a difference between correlation and causation, right? If you dig in deeper, and there's a fantastic macroeconomist named Peter Linneman, who I follow, who's a professor at Wharton, and he talks a lot about this. He talks about, if you really dig into the data, it's not that interest rates and cap rates move in lockstep. It's what really drives cap rates is the availability of capital to invest in real estate, right? And so if you think about that, well, when interest rates are lower, debt is cheaper, the capital is more available, right? And so that increases the amount of capital chasing real estate. That's what traditionally, as interest rates have gone down, has moved cap rates down, and in converse, as interest gone up. The thing that's different right now is, remember back to COVID. Remember I believe the number ended at something like $9 trillion that were created through the stimulus through COVID, right? A lot of that capital really still hasn't been deployed. And there's about 5 trillion, if you look at balance sheets, sitting on the sidelines, waiting to be deployed. A lot of that's sitting in institutions. And so if you think about that's what's different than any time before, is this just dry powder sitting on the sidelines that needs to be deployed, and needs to be deployed for a yield. And so when you look at that, as much as interest rates have increased, there's still so much demand out there and so much capital chasing a great risk-adjusted return. And it's not the folks like us that really drive the needle on that. When you think about the REITs, you think about the Blackstones of the world, right? That have billions and billions of dollars waiting to deploy. That's really what's driving it. So that's why I don't think we're going to see, and we haven't seen to date, this large cap rate expansion following interest rates. We've seen a little bit, but it's because of that capital that's seeking deals. As long as that demand is there, it's going to keep prices high and cap rates down. I think we are going to see a little bit of a buying opportunity, but I think as soon as the interest rates come down, which will happen in a couple of years, I think the floodgates open. And I think, Steve, our acquisitions director, had an awesome analogy of it. Was like, you think about Black Friday, it's going to be, folks chasing that $500 flat screen, at Best Buy, right? Climbing tooth and nail to get to that. I mean, that's what it's going to be like. It's going to be, I think, a buying frenzy again. So again, why I think it's so important right now over the next couple of years to pick up great assets in great markets and be in a position to offer those as everybody else comes back into the market.
Yeah, and that's what it comes down to, right? Great assets, great market, and staying ahead of those macro trends, right? That's the way it's always been in this space.
100%, man. I mean, it's all driven. At the end of the day, it's a fantastic long-term asset. If you can get through the noise and continue to act, these are the time periods right now where there's opportunities to buy, which they're, in a position that we haven't been in over the past, 12 years, as things have only gone up and up and up and up.
Yeah. Well, let's transition here. Let's help our listeners who want to get to this stage avoid some pitfalls, right? So you look at yourself coming from this one-man team to really setting a solid foundation for this rocket ship to launch on. What are your biggest lessons learned, over the last 6 months or further, as we go through this kind of rapid growth phase?
That's another really good question. And as I was thinking about this, spending a lot of time at the end of the year, reflecting what went well, what didn't go well, 3 things really rose to the top for me, especially if you think about this growth trajectory in 2022, which I think is important to frame up, right? We acquired more than double the size of our portfolio, acquired more than 400 units, brought on a bunch of team members. We completely redid our tech stack from beginning to end with better quality solutions. We went through a property management transition where our old property manager just was not performing for us or our investors. We had to rip the Band-Aid off, and that's one of the most painful things you'll ever go through. But just a ton of change. And when you look at what we've accomplished, yeah, there's obviously things that went well, things that didn't go as well, and there's always lessons to be learned. So top 3 are, first one is, no matter what your plan is, you got to be nimble and you got to just roll with it. You can't fight the universe. You can't hope and wish things had gone differently. You just got to take in the information, make a decision with the best information that you have. We're never going to have perfect information, right? For example, for me, I laid out this big 5-year plan that I had, this 5-year growth plan. And And honestly, everything on that plan has happened probably twice as fast as I expected. And it's one of those things where you could fight it and fight the timing and say, no, we're not supposed to be there yet. Or you just have to embrace it. And that's what I've done and said, even from Curtis, like you bring you on, that was not on my radar to form a partnership with a guy like you, to focus on capital raising, right? And really, really amp up that and allow me to focus on my other core areas, right? But then that led to the rest of the team. And if you think about, everything that we've done, the growth in the portfolio and the opportunities in front of us, relationships we've built, it's all happened faster than I expected. And so I think it's this idea of you've got to be able to have this flow and this nimbleness about you. I mean, as an entrepreneur, and you've got to just be able to have a plan. But where I think a lot of people go wrong is they spend too much time on the planning. You write a 50-page business plan, right? At the end of the day, in a small business as an entrepreneur, like things are going to change. And every 3 months, I mean, the world's going to look completely different to you. And I think you need a solid plan as a North Star, but you need to just be able to constantly pivot and readjust throughout that process. So that's one. Be nimble, roll with it. Number two is don't be afraid to make mistakes, but learn from those mistakes, right? We've had so much change. If you think about some of the big disruptors within our company over the last 6 months, our tech stack, right? We've totally redesigned our tech stack to be better than before. What does that mean? Well, we switched from being a Google platform to being a Microsoft platform. We migrated everything from Google into Microsoft. I mean, that was a major disruption. Taylor, our manager of investor experience, really took that on and owned that project because we really didn't have anybody else to do it. And I don't think she'd be mad at me for saying this. Like, tech is not necessarily her strength. Relationships are her strength. But she did the best she could. And she said, you know what? I'm going to step up. I'm going to do this. She did a great job. We had hiccups along the way, but just it was a disruption. We're looking for documents, finding things, doing the cleanup afterwards. If you think about on marketing, switching from like a MailChimp to a Cadillac, like HubSpot, to be able to better engage with our investors, with new investors, current investors, but that switch over. We switched investor portals that just provides a better service to our investors, more transparency, better automations, different things. I mean, all within the last 6 months as we're onboarding new people, right? So you're going to make mistakes, but you just got to roll with it. And you just gotta figure it out as you go. And you got to be really good at critical thinking and problem solving. And I think the ability to delegate and also have people step up is so critical.
Right. And I think, when something isn't working or is holding you back, right? You've established this foundation and you're trying to put the right people in the right seat, but also have the right tech stack. If something's holding you back, you can't be afraid to lean into that, get uncomfortable, rip that Band-Aid off, as you said, and move forward. Because, not doing that and waiting, it is really only going to delay the rocket ship from taking off.
Yeah, I think that's right. And being able to spin into that with the faith that, we've invested in more expensive tech, but we're going to get the returns. It's going to provide a better experience for our investors and everybody we interact with. The other one, as far as don't be afraid to make mistakes, is just org chart. I had an old boss in my consulting days that said org charts are ephemeral, right? Meaning they're always changing. And sometimes with org charts and hiring, because our org chart has drastically changed from what I first thought to now 6 months later, sometimes you don't know what you need until you figure out what you don't. And I think we've had some great lessons there. I think we've been slow to hire, quick to fire. We've made some tough decisions, but sometimes you just have to, you think you need one thing and you realize that's not a right fit. And you just got to, again, be nimble and change and move on. But don't be afraid of that. And don't be afraid when you recognize that the person's not a right fit, to act quickly, because the people are the key to your organization. Last one is property management. Man, this has been a roller coaster ride. Our investors know this. We've been transparent about it. But I mean, our property manager who has grown with us from the beginning just couldn't grow with us anymore. I think, frankly, we outscaled him. Performance really was hurting in the past, few months of 2022, to the point that all the action plans we put together and all the things that we tried to do, from taking my own marketing team and having them try to generate leads, to everything, was just distracting us from what we needed to do. And at the end of the day, what I realized was, in this relationship, we're the customer. And I felt like we were putting more into it than we were getting out of. And I was spending way too much time in management. And so we had to rip the Band-Aid off, and we did. And it was difficult. It happened in December. It happened through the holidays, but we brought on two amazing management firms, one for our Indy portfolio and one for our Ohio portfolio. And man, is it a night or day difference and a breath of fresh air. And we're on the upswing, and things are getting righted. And I know that we're going to be better positioned. And I know that we're going to be able to do right by our investors through these amazing new relationships. And the great thing about real estate is, real estate is a problem solving business. You're going to have problems, but that's why these are long-term investments, right? That hiccup over a couple of months isn't going to diminish the value over the long term of these investments. We're still going to provide, I think, exceed return expectations on all of our portfolio. And that's one of the great things about real estate. But you've got to again be willing to rip the Band-Aid off and do what hurts to get to a better place. And so that's my number 2. Don't be afraid to make mistakes, learn from them. The last one is you got to have faith over fear. I love that quote. Faith over fear. You got to become comfortable being uncomfortable. I don't think people spend enough time talking about just that concept that you're never going to feel good when you're growing a business, right? Because there's always new things. It's this idea of you've got to become comfortable leaning in to the suck at times. You got to become comfortable being willing to figure it out. And so if you're not willing to do that, I don't think you're going to be able to successfully, thrive in this business, because there's things that come up. You're solving problems every day, but at the end of the day, you've got to have faith. You got to surround yourself with the right people and really invest in those people. Surround yourself with the right products, buy the right assets, and trust the process. If you do the right things, the outcomes will come if you keep working hard at it. And so I think that's what we've realized and seen. And we're in a fantastic position to start 2023. I'm so excited. Like you said, the analogy, for this rocket ship to take off. But a ton of lessons learned through 2022. And so my hope is that you guys can benefit from our lessons. I know our investors are benefiting from our lessons as we continue to improve process every day. But if you're out there trying to do it on your own, I hope you take these and can run with some of these and continue to, just improve your own process. And one thing, Curtis, I know I didn't really prompt you on this, but I'd love to just put you on the hot mic for a second and say, there's got to be a bonus lesson learned out there from a guy that's raised over $150 million in capital, to say, through a tough time in 2022, what's your biggest lesson on building investor trust in a tumultuous time, and building those relationships and helping folks, let's say, make their first real estate investment?
Yeah, no, it's a great question. And I think you kind of hit on it a little bit there. It really does come down to trust. I think a lot of times when people look at private equity or syndications, you think about the deal, you think about the marketing deck, and that you just need to walk somebody through this deck and get them the IRRs and the multiples and the debt coverage. But really, that's not what it's about, right? What I've noticed, from back when I raised money at the pizza restaurant and then the Speakeasy beer bar, it's really those relationships you have and the trust that you have in those relationships. That's sort of where the money follows. And what I mean by that is everybody is so busy in their day-to-day lives that, you know, what they do with their finances and how they invest sometimes takes a back burner, or gets, you know, put to the side. And, you know, for most people, you know, they save money and they hand it over, you know, to various financial advisors. And they know that they want to get into real estate, but they don't know how, right? So most of my job is really being available, really 24/7, fitting into people's busy lives, whether that's weekends or evenings, and just being there for them to discuss the basics. Sometimes it's, what is commercial real estate? Sometimes it's, can I invest my self-directed IRA? What is a self-directed IRA? I don't understand cap rates. And a lot of it just comes down to being available to answer their needs, you know, and a lot of that is really just education. And I don't really ever feel like raising capital is a sales job. It's a relationship job. And at the end of the day, you know, all the people, you know, whether it's from your base or the friends and family in my life along this wild journey that I've had, they're all excited to get on the phone. They're all excited to learn about a new opportunity. And each one of them has a unique story about what they need to get comfortable, right? And that's at the end of the day what people are trying to do. You know, most people don't want to become experts in this space. They need to trust you, the GP. They need to have transparency. They need to know that that operator is running the business with integrity, right? And if all of those criteria are met and you can build those relationships, whether it's through education or through a dinner or through, you know, out there doing community service or an adrenaline event, you know, those type of relationships are what follows the money or is open to hearing, you know, what opportunities you've had out there. Because like you said, there's tons of money on the sidelines, and that's institutional. Like when I look at, you know, how much institutional money's on the sideline, you know, that's great. But what is also very apparent to me is the amount of money from the normal retail investor through all of our grassroots family and friends that are out there, that there's so much money that wants to find alternative investments, but it doesn't know how. And that's where building your team around the education side of why is multifamily so good? Why do we feel it's the best risk-adjusted return out there? Why does it outperform so many other asset classes, regardless of the economic cycle? You know, that's the mission I'm on, and why I love this space is around educating people on how to diversify their portfolio so that whatever that might be for them, they find their risk and return that helps them sleep better at night, helps them meet retirement earlier, helps them pass down generational wealth. There's so many reasons on, you know, why I love getting on that phone call with whether it's somebody I know or it's a brand new investor that's looking to get into our community.
Yeah, I love that. I mean, and that's why we're so aligned, right? It's about the education, and it's about just helping people gain access and better returns. And so we're going to wrap up the show there. Man, it was fun being in the hot seat. Thank you, Curtis, for, you know, providing the interview and the commentary. I hope these lessons help you guys, give you some better insight into who I am and what we've been going through, some of those lessons learned that you can avoid. And here's what I want to do. I think this would be a great opportunity. Curtis is a new member on the team. I want everybody to get to know him. So what I'm going to offer up is, you know, just a free half-hour call with Curtis. I mean, focused on education. If you want to get any questions answered, right? Like he said, how do you invest with your IRA? What is an SDIRA? what's going on in the market, just ask advice. I want to open that up. So what we're going to do is we're going to put a link in the show notes. You click on the link, it'll allow you to schedule some time with him. And obviously you've heard from him today. He's a great resource. So guys, take advantage of that. And with that, we're going to wrap up the show, and I'm excited to kick off this new season and give you guys some fantastic content. Hope you guys have a great rest of the day. Go out and invest like a pro.